Here is your new Sky Bay end of week markets report, a video I post every Saturday going over everything that happened in markets in the week. If that's something you like the sound of, please subscribe. So this week was all about the US economic data that was released, specifically with regards to the US labor market. And we had some pretty big readings today that exceeded expectations significantly to the upside. We had the JOLTS reading on Tuesday, which came in significantly above expectations, and we had the blowout NFP reading on Friday, which was nearly double what economists were forecasting. So I'm going to get into what all of that meant for markets this week and what it means for the economic outlook for the US and in turn the rest of the world. So on Tuesday we had the latest JOLTS reading, which is short for Job Opening and Labor Turnover Survey, and it came in at 9.61 million as compared to the 8.8 million forecast. So this was dramatically above expectations, to the tune of 800,000 more jobs opened in August than was forecast by economists. So what this means is that the labor market is still incredibly strong. You can consider the JOLTS reading an indicator or a data point on demand for labor in the US economy. It's how many jobs are opening in the labor market. If you haven't watched any of my previous debriefs, you really should, because it will get you up to speed on everything that's happening right now. But in short form, the Federal Reserve wants to see the labor market cooling. It wants to see jobs slowly, not too fast, slowly coming down in what it describes as a soft landing, or the hopes for a soft landing, meaning the US economy cools slowly as such, in which case inflation comes down without causing a recession. All right? And this JOLTS reading coming in is just an absolute whack in the face of any kind of expectations of the labor market coming down slowly, because it shows that there's still an enormous demand for labor out there in the US economy. And of course, one data point does not a trend make, but it's still a very significant number, and particularly how far it exceeded expectations. So markets did react to this data, and I'll get into all of that later on. So that was the first big thing that happened this week in terms of data, and as I said, I'll get to the market reaction at the end of this point. I'm just going to summarize the whole week first. Then on Thursday, we had the weekly unemployment claims, which again came in relatively low, meaning unemployment claims are low, indicating, as the name suggests, low unemployment in America. So the reading came in at 207,000 as compared to the 211 that was forecast. So again, lower unemployment than forecast, and still the trend is low coming in on these weekly unemployment claims, pointing to low unemployment and, in other words, a strong labor market, which is what markets don't really want to see right now. They want to see the labor market cooling, not too fast and not too slow. They want to see it coming down in line with the Fed's soft landing expectations. So these readings staying low, below 210,000 is relatively low as compared to what we've seen all year. It does point to the labor market staying strong, as does the JOLTS reading we had on Tuesday. The next big reading that came out this week was the blockbuster, one of the biggest data points that financial markets get every single week, the Friday non-farm payrolls report. And I did a short in this earlier in the week to show you the initial market reaction to this news, and it was quite severe. But the non-farm employment change came in at 336,000 as compared to the 170,000 that was forecast. So nearly doubling the expectations. Again, showing strong labor market conditions, which leads to, as the theory goes at the very least, stronger growth, ergo stronger inflation, ergo higher Fed rates, right? That's the general narrative that's been surrounding the labor market for the last few months. So the main blockbuster data releases, the NFPs, the JOLTS reading, the unemployment claims, they came in hot. But we did see some slight moderation in the unemployment and wages outlook. Unemployment stayed elevated at 3.8%, same as last month. And the monthly wages, came in at 0.2% as compared to 0.3%. So what this means, in plain English, is that although more people, like the blockbuster NFPs, more jobs were added, more people got jobs, but the wages aren't going up with it. And that's the main worry. As I've said in previous videos, the wage price spiral is what really freaks central bankers out about the tight labor market. Okay? So these data points came in this week, and here is how markets reacted. I'm going to go over to my charts, and we're going to deep dive into equities, bonds, FX. So the first market we're going to look at is US equities. So this is the benchmark for the US stock market. And talk you through what happened this week. Here at the beginning on Tuesday, we had that JOLTS reading come in. That really spooked stock investors, given the equation I gave you earlier. So tight labor market is implied to create stronger inflation, or growth I should say, which results in stronger inflation. There's obviously the risk of the wage price spiral. And in turn, the Federal Reserve stays more hawkish in its monetary policy stance. So this spooked markets at the beginning of the week, which drove equity benchmarks down at the start. So when Tuesday came, that JOLTS reading came out, investors were freaking out a bit. They didn't want to keep their money in stocks, so they sold off. What is quite interesting is what happened towards the end of the week when we had the NFP readings come out that showed again a tight labor market, strong labor market I should say. Almost double the expectations were released. The actual figure came in with almost double than expected, as I just explained to you. And yet stocks climbed. Why is this? Well, it has a lot to do with the other data points that came out around it, with wages not gaining as much as previously expected. This really helped boost investor sentiment in stocks, in that the Fed isn't going to be too worried about the wage price spiral so long as wages aren't increasing with the labor market strength. That's one thing that boosted investors' sentiment. And another is the forecaster. This is the last of the strong NFP readings that we're seeing. And this is a chart, this is a screen I've shared on these videos before. This is the CME Fed Watch indicator. So this is basically ratios determined by the swap markets that gauge investor confidence or sentiment around the Federal Reserve's expectations. So basically, these charts are, is the Fed going to hike or not, right? That's what these are gauging. And at the moment, we're at 525 to 550, so the upper bound of 5.5% interest rates in America. Markets are saying there's a 73% chance that the Federal Reserve is going to hold at its next meeting, right? So markets still, in the face of the Fed hawkishness we've seen with the dot plots through Jay Powell's verbally stated terms that they're data dependent and that they are erring on the side of quelling inflation more so than they are than worrying about growth. Markets are still saying, yeah, that's cool, but we think you're done hiking. And you can go over through to December. Same again, the majority of markets are expecting no more rate hikes. So again, despite what the Fed has literally signaled in its dot plots, despite the vast majority of not the vast majority, but the majority of FOMC members saying, yep, we see one more rate hike coming this year, markets just aren't buying it. So that goes some ways of explaining why stocks were climbing towards the end of this week. So this is the S&P 500 over the 5 days. So this is Monday through Friday. This is what we saw. Bit of seesawing, down at the beginning of the week on the strong JOLTS readings, up towards the end, right? To give this context, we're going to look at the 3-month chart. Stocks right now are down. All right, and this is on the back of what we're seeing in the bond market. We'll come into that in a second. The S&P 500 is strongly down at the moment. Again, on that Fed hawkishness, on this strong data. And there's a little bit of seesawing on the intra-week basis. But right now you can see stock investors aren't looking so hot over the 3-month time frame. Year to date, here's how the S&P's performed. So you see at the moment, we peaked up here back in beginning of August, end of July, and since then, markets have been a little bit standoffish, a little bit risk off towards putting their money into stocks because they're just not sure what the economic outlook's going to be. Is there recession? Is the Fed going to stay hawkish? Is there going to be more hawkish upgrades to the Fed expectations? We don't know. So we're not going to be keeping our money in stocks right now. Okay, and this, we see a similar thing across the NASDAQ here. So this is the technology sector. This is it across the week. Same as the S&P in terms of its pattern, down at the beginning, climbed towards the end, but you can see it finished higher than it did at the start. But again, over the 3-month, we've still got this confusion, or the lack of confidence, I should say, the risk-offishness in equities in the American benchmarks. What's really been making headlines the last few weeks really is the bond market, specifically US Treasury bonds, right? And here's why. Here's what we've seen the last 3 months. Boom. Here's the 30-year, below 4% yield. This is 30-year Treasury bond yield, close to 3.8% back in July. And this week, it broke through 5% twice, right? So we're seeing this huge rise in bond yields over the last 3 months. And this week was no different. We saw the sell-off in bonds continue as yields were spiking. And here's it breaching the 5% level twice this week. And this is big news, not just in terms of markets, but in terms of economics, because the 30-year Treasury is used as a benchmark for mortgages and other financial rates used in the actual fundamentals of an economy. So these yields going up is big news, guys. And if you're new to markets, just know that this climb here in bond yield from 3.8% up to 5% is enormous. It is an enormous move in bond yields. It means bonds are selling off. The US Treasury Department is pushing up the yields to get people to buy them, right? This is a huge climb. And so to explain what happened this week, we saw bond yields again. Here comes that JOLTS reading on Tuesday, the 3rd. Boom, up they go. People are worried about the Fed being more hawkish. They're worried about US growth leading to more inflation again. This is a bullish signal for bond yields, bearish for bond prices. And what was quite interesting this week, certain markets are diverging in their behavior. You usually see the same fundamentals that drive bond yields up are often the same fundamentals that drive the value of the dollar up. So here's the US dollar index. We can use it on a specific FX pair if you want, say the Swiss franc. October the 3rd, the strong JOLTS reading came in. As I just showed you, bond yields soared. They kissed 5% after that JOLTS reading. And yet, here's what we see in the price action of the dollar Swissy. An initial spike given, but then a sell-off in the dollar. So we're seeing FX markets reacting in a different way to the bond market. So stocks fell, yields climbed. Strong indicators of a strong US labor market, strong growth, ergo sustained Fed hawkishness. all of the reasons and fundamentals you'd expect the dollar to increase, yet it sold off. And again, that blowout NFP reading, boom, there you go. An initial spike, but again, an even bigger sell off afterwards. And to look at this across the dollar index, here we are. So this is just an amalgamated price of how the dollar performs against the major currencies. And again, you see it. Just Tuesday comes along, strong jolts, there's that initial spike up, and then just a sell off throughout the rest of the week. Momentum added by the strong NFP readings, which is strange. So there's the breakdown on what happened in markets this week. It was solely focused on the US labor market readings and what it means for the Fed hawkishness we've seen over the last few months. Bond yields are still absolutely soaring and the price of bonds is falling through the floor. Stocks are still in a bit of a malaise as investors are entirely uncertain as to whether the Fed will carry through with its hawkishness, whether there'll be a recession. People really don't want to put their money in the stock market right now. And thirdly, the dollar is starting to sell off, even in the midst of strong economic data. So these are important data points to consider moving forwards. If you like this video, please like and subscribe, and tune in for tomorrow's briefing for the week approaching. Thank you.